Closing bell 6 minutes away. Left in trade. Here's where the markets need to be to punch into positive territory for the week. So the S&P at the moment and the NASDAQ are up slightly, but the Dow overall for the week has to be up more than 104 points. We're not there. We're down 7. S&P has to be up 3.20 points. NASDAQ must be up more than 27.45 points. So the S&P just at the flat line there. So this is a horse race. Stay with me for the next 5.5 minutes. Now compare this. U.S. exchange-traded fund assets in March rose to $1.94 trillion. That's a 17% increase from just a year ago. But now investors in the past couple of days seem to be turning tail. U.S. mutual funds and ETFs saw their biggest monthly exodus since 2008, and this was in February, $41 billion in outflows. So as an ETF investor, you own an exchange-traded fund, many of you do, you might be asking yourself, should I stay or should I go? And what's the problem here? Pacer ETFs President Sean O'Hara says stay. He's the bull here on ETFs. And Vince Deluard is Vice President Global Macro Strategy for INTL. He says you need to be careful, cautious, and bearish. All right, Vince, I will begin with you. Make your case. What do you fear about ETFs? And give us some examples so our viewers understand why.
Well, the first thing is I don't mean to make a blanket criticism against ETFs. I mean, ETFs have been a wonderful way for investors to gain exposure to a lot of assets and countries, and they've done that in an efficient way. The criticism that I had kind of focused on a smaller subsector of the ETF industry, which is the so-called smart beta funds. Funds that do not just try to replicate an index, but actually try to outperform that index. And the case that I was making is that most often these funds will not live up to the hype, and they actually end up underperforming the asset, and they end up kind of skewing investors' money towards a small group of stocks that tend to be more expensive, and in that sense, the ETF bubble feeds the stock market bubble.
Okay. Can you give us an example, Vincent, about one in a certain situation that you're most concerned about?
Well, in general, all these funds rely on the same principle, that they look for, quote-unquote, factors that have performed well over time, and then they screen the stock market to invest in these factors. Now, we're coming off of a period of about 35 years of falling yields. So any factor that has performed well in the past 35 years tends to be correlated with falling yields. So you end up with funds like low vol, quality, high dividend yield, and essentially bond proxies. So these funds will put investors in stocks that behave like bonds just at the time when the bond market is entering a secular bear market. So going forward, I don't think that the performance that you see from backtest is going to uphold in the future, as is generally the case with backtest. Backtests only work in the past. People care about the future.
Okay, Sean, it sounds to me like Vincent is saying this. It's not so much ETFs that mimic big tech or large manufacturing with a bunch of stocks in a basket. It's the ones that get a little fancy, like the double video game shorts or things like that. But you're bullish on some of those, are you not? Especially the dividend plays?
Well, let's just all calm down a second. There's $3 to $4 trillion in ETFs globally. There's $17 trillion in mutual funds. And all anybody's really trying to do is accumulate wealth for themselves in one vehicle or the other. ETFs have a long way to go before they'll even come close to the amount of assets under management that mutual funds are. Now, with regard to the developments in the ETF business, the leverage stuff, the invest stuff, we're not real big fans of. We're not even really big fans of factor stuff. We buy companies based on fundamentals and on measurable metrics like free cash flow yield in our cash cows ETFs. So we believe that companies that generate a lot of free cash flow and free cash flow yield will do better over time. If you're worried about the overall market, which some people are, you could buy the Qs, for example, and get exposure to the NASDAQ 100, which that's where all the return has been, and it looks like tech will continue. But if you're a little bit cautious, there's a way to invest in the Qs using, like, for example, PTNQ, where you can get an ETF that will use the 200-day moving average as a measure of whether you stay in or out of stocks. But this debate has been going on about somehow that ETFs are being disruptive to the market, and I'm not buying it.
Well, they're not disruptive right now, Sean, but Vincent, let me give you this one. Gold ETFs. There's some question as to whether, if all these investors pile into gold ETFs, depending on whether it's a triple euro, gold short, who knows, but if the herd, the investment herd, were to suddenly turn tail, for who knows why, some headline risk, do they have enough physical gold to back it up if people want out?
Well, I think it depends on the ETFs. I mean, if I think of the largest gold ETF, GLD, my understanding is that it's physically backed by gold, and they actually track the amount, the exact weight of gold that's in the fund. Now, I think the case you're making is equally correct, that there is more virtual gold, like paper gold, than you have physical gold in the world. So if everyone suddenly were pulling all their money out, indeed, there would not be enough physical gold. Again, I think most investors that buy gold through ETF do it through a vehicle like GLD, which, you know, yeah, if the financial system would collapse...
Oh, you gotta go. I'm sorry, we're up against that closing bell.